Good morning, everybody, and welcome to our exit and succession planning webinar this morning, which is aimed at business owners that are looking at exiting and leaving their business in the next few years. We expect to be talking for around 30 to 40 minutes this morning, and we have Tim Humphries, Anand Chandarana and Philip Bird joining us this morning. If you have any questions, please do feel free to post them in the chat box or the Q&A. If we have time, we'll deal with them at the end. We're happy to share a copy of the slide deck with you later today. If you'd like this as a PDF, please feel free to drop me an email at hello@rpgcc.co.uk. A quick introduction to RPG ourselves. We are a full service firm with an office in Gracechurch Street and an additional office out in Woburn. We are ranked in the 50-50 for accountancy firms here in the UK and in the top 20 for mid-tier accountancy firms by Accountancy Age. We are also really excited to be listed as finalists in this year's Accountancy Excellence Awards and in two categories this year, so Audit Firm of the Year and Large Firm of the Year. So we're looking forward to see what that brings at the end of September. We're also ranked in the Corporate Advisor rankings as audit providers to listed companies here in the UK. We currently have 16 partners and around 115 staff, although that number is quite fluid as we do seem to be experiencing rapid growth as we continue through the remainder of this year. As I said, we're a full service firm covering all areas from audit, accountancy, bookkeeping, payroll, corporate tax, personal tax, as you would expect. Philip being here today also demonstrates we have a corporate finance team that's involved in M&A, business buyouts, management buyouts, etc., etc. We also have a full service financial services team who are separately regulated by the FCA, and they sit inside us and work alongside our team to help our clients with wealth management. Philip is our corporate finance partner. He's going to start us off this morning, followed by Anand in corporate tax and Tim, our tax partner. With no further ado, I'm going to hand over to Philip. Philip, over to you.
Thank you very much, Kay, and very good morning to you all. And thank you for attending this session with us this morning. I just want to provide a few words of introduction of why planning for exit and succession matters in privately held business. Selling and moving on is probably one of the most important decisions owners will take in their life. It's a very complicated area. It needs specialist help and you need to get it right. And clearly the benefits of getting it right are that when you do come to sell your business, you maximize the actual value of it. And through our help and with tax structuring, you can minimize the tax liability. So walk away with the maximum amount you can. Successful exit planning also involves, not only a mixture of planning for your exit, but how that translates into your own personal goals, what you want to leave for your family, and the wealth management and financial security. So it's clearly interlinked with very many other very important decisions that shareholders take. And the aim really is to take the stress out of the future by future-proofing through planning for exit and ensuring a smooth transition for you as shareholders, for your family, for your employees and other stakeholders in the business. So it's incredibly important you get it right and you do think early about it. And when we think early about it, we tend to say, if you are thinking of exit, you need to start planning anywhere between sort of 1 and 3 years in advance for that. So if we move on to the next slide, what are the exit options and routes for you as shareholders and private company owners? Well, they are various and numerous and all have different shades to them and complications. Right at the top, I suppose we'd say trade sale, and that's you selling your business to another company who's very similar to yours and perhaps is on a buy and build growth acquisition opportunity and wants to acquire your company for its customer base, its market share, etc. Many people have heard of private equity. They are a very active investor across all sectors in the UK and economy and have been for many, many years. They can either offer standalone management buyouts, which is effectively you passing partial ownership of your company to the management team you have in place with the private equity firm, not only providing financial support for your management team to do that, but also for them to be able to take what's typically a majority shareholding. So they offer routes for growth. They're very interested in short, medium-term capital gains and improving the financial performance and passing ownership on within a period of 3 to 5 years at a higher value than they've bought it. It's not for everybody, but for very ambitious management teams, and you as owners may feel you want to offer that possibility to your management team. It's a very attractive option. Over the past few years, there's been an emergence and increasing importance in selling businesses through EOTs, or employee ownership trusts, and this is effectively passing control on to your employees. Tim and Anand will talk a little bit more about the tax implications of that, but the benefits for you of owners is it is effectively free of any capital gains tax, providing you get the structuring right. The sort of fourth exit option is for you to list on one of the UK, probably UK rather than international exchanges, stock exchanges, and there are a handful of them depending upon what type of company you are, where you are in your life cycle. You know, for those mature businesses, listing on the London Stock Exchange, providing you're big enough and meet criteria, is certainly a way forward as an exit option. There's also the alternative investment market, which tends to be for high growth acquisitive companies and very early stage and particularly technology companies. There are exchanges such as Aquis. And finally, you are able, of course, to sell your shares to other groups of existing shareholders who may be in there, other family members, other third-party shareholders, to realise some capital value, and that can be achieved by sort of funding that through external finance debt, typically. So those are just what we would say as being the normal exit options that we as advisors help private companies to look at. I mentioned at the beginning it's very important to prepare your business for sale. We've already touched on a couple of these things. It ensures a smoother exit. And what we really mean by preparing your business for sale is really that it's in a very robust shape and attractive to an acquirer. And when you go through a process of what's called due diligence, which is effectively an acquirer or interested party checking and verifying your financial position, you will appear very professionally managed. Hopefully nothing will come out through that due diligence process because you've already thought about and prepared and protected against it. So it all protects value and helps you achieve a smoother exit. And Tim and Anand on the tax side can advise on the best way to structure any sale, not only from a personal point of view but also for a corporate tax point of view. One of the things we offer and recommend if you are thinking about selling is something called vendor due diligence. So actually, when you go out to speak to interested parties, we already have worked with you to prepare a financial pack, which effectively saves the buyer doing it. Costs can sometimes be shared for that kind of work we do with the buyer, but it is a very proactive way of speeding up the exit process. So what makes a business attractive to a third party and an acquirer? And what are some of the things we could help you with as an advisor to get right, to make it attractive and protect you as you go through an exit process? Well, obviously the financial position of the business is extremely important, and what we need to evidence and you to evidence is you've got a track record of growing sales, profitability, cash flow. But also, when you look to the future, there are further growth opportunities that will continue that trend to increase profitability, revenue, and cash flow. And that's normally in the form of a business plan, and we can help you work on that. But it's very important that not only do you demonstrate that you are a very solid financial business at the moment, but that's going to continue in the future. Other things that will make you attractive and which an acquirer will focus on is obviously your customer base. One thing parties don't like to see is heavy customer concentration. And what we mean by that is sort of a large part of your business is with a small number of customers. And with those customers, it's obviously much better to have evidence of very long-term relationships with them. You've been serving them, dealing with them for many years, or you have, underpinned contract relationships, which give you some visibility over future earnings and profit and recurring income. The other area sort of that makes you attractive and an acquirer will place a lot of focus on is obviously the management team you have in place. And you as owners, if you are thinking about moving on and selling, then you really need to make sure you've got an independent management team that can continue without you at time of exit. That is very, very important. A management team which is experienced, been running the business for a few years on, and an acquirer can rely on to continue running that business post the sale of the business. Growth opportunities, I've already mentioned that. It's very important to show, there's some more fuel in the tank, if I can put it that way, for the new acquirer. And then clearly the whole area of intellectual property and technology assets, have you got brands, have you got websites, is it all protected? All that will underpin value and the attractiveness to an interested party. So that's all for me. I'm now going to pass on to Tim.
I'll actually take on this next slide. So this is just a summary of the tax considerations on the exits that Philip was really talking about there. So depending on your type of exit, you'll obviously have capital gains tax, corporate tax, inheritance tax, and personal tax considerations. They'll potentially all have different outcomes. So we work with clients to work through the various options and try and tailor the results so that it results in the sort of most tax optimal position. So if we take capital gains tax first, one of the most common considerations is how the proceeds will be structured. So in general, anything that's basically paid in cash, even if it's deferred cash, is taxable in year one. However, you can use loan notes, and to use the technical terminology, there's a difference between a loan note that's a qualifying corporate bond and one that's a non-qualifying corporate bond. They both allow you to defer gains into the future. On the qualifying corporate bond, there is always a risk that if the subsequent payments don't get made, you then are not able to go back and claim the tax that you paid earlier. So there are options of flexibility as to how this consideration is structured. And in most cases, even when there are loan notes, you still have to value the loan notes at the time so that you do end up paying tax up front if you want to secure often BADR, for example. Then there's earn-outs. So again, quite common in the deals that we see, that a buyer would want to keep the vendor in the business for a year or two in order to help drive the business and often give targets, turnover targets or EBITDA targets under which further payments could be made. There is obviously a risk here that this could be subject to employment taxes. And the rule of thumb is, the longer this sort of earn-out period is, the more risk that actually HMRC could come along and say, well, actually, this is more akin to an employment term rather than in respect of the shares that this person is holding and selling. In terms of BADR, business asset disposal relief, current rules are 2 years, 2-year qualifying window. Obviously, the value of the relief has been watered down. It's now 14%, and it's going to go down to 18% of a tax rate following April next year. Still valuable, even though it's only first £1 million of gain. And again, it's a good relief if you can manage to structure the sale in that way. Again, we often advise people, if it's a husband and wife business, to structure it such that both individuals can get the relief the full maximisation of the relief. Equally, as is referenced there in the next line, you can also give to other family members and prior to a sale if you want to use their basic rate bands for the lower tax rates. It was referred to earlier, Philip mentioned EOTs. With your purely tax hat on, they're great if you can structure them for a vendor because, as is referenced there, you can get them CGT free. The reason why I think often a lot of business owners potentially don't then go for them is it doesn't necessarily provide the right incentives for the remaining employees. And there's been the provisions of the EOT legislation have been curtailed somewhat such that the vendor can't be involved as much as he could have been before. It changed last year. So potentially it's less interesting. However, in certain circumstances, especially when there's a sort of a wider pool of employees and there's a desire to share the wealth amongst those employees, then the EOTs are a very good way of doing that. And then if we move now on to corporation tax considerations. So here again, we work often with clients to structure companies and businesses for sale. So one of the things that comes up relatively frequently is in the due diligence process. Occasionally, you'll have a buyer that's a bit nervous about part of the history of the company, something that's happened in the past, that there may be a possible liability that could occur in the future. So you can, in those circumstances, hive down the trade and sell a fresh new company. Now, in terms of the sort of planning ahead here, as Philip said, it's always worth thinking about, well, actually, this subsidiary, it needs to have been around for at least 12 months. So, in the run up to a sale, maybe in the sales process, a couple of years out, maybe think about actually already having the subsidiary in place, because without that subsidiary, you won't get this substantial shareholding exemption, which exempts the gain for corporation tax purposes in the name of the company actually selling the shares in the new subsidiary. Also, as well, other corporation tax considerations, and goodwill is always something that people focus on, and intangibles. And also, again, another point on structuring is demergers as well. So again, if you've got separate divisions or separate, so you've got a trading business and some assets, investment assets, often you'll have a buyer that's only interested in the trading part. So you can do a pre-sale demerger so that you're only selling the trading business on to the acquirer. In terms of the goodwill and intangibles, again, there's discussions there about allocation of proceeds and what the value is for those proceeds, because sort of the goodwill and intangibles regime, the tax relief on the regime has gone up and down, a bit of a roller coaster over time. It's but nowadays there is a limited form of tax relief on goodwill. So often there's a lot of discussion around allocating the proceeds, the consideration across the asset base to make sure that the optimal position is obtained. And now I'll hand over to Tim on estate planning, inheritance tax.
Thanks, Anand. Good morning, everyone. So yeah, as Anand said, I'm going to just talk a little bit about estate planning strategies. It's worth noting, first of all, that obviously if you are looking to sell a company at the moment, the chances are you own shares in a trading entity. That entity, as it stands, is likely to qualify for 100% business property relief as of today. That relief is going to be curtailed from next April. The first £1 million value will still qualify for 100% relief, and then 50% thereafter. But it does mean that if you then sell those shares, you're going to end up with a pot of cash rather than the shares. So you're suddenly going to go from a position where you have pretty much, as of today, no inheritance tax liability on this asset, to a full inheritance tax liability on the cash you're going to receive instead. So there are some ideas to think about before you actually go ahead and sell those assets, to see if there's anything you want to do with that value first prior to sale. So if you are just thinking about making straightforward cash gifts, for example, after sale, then fine. That's an easy thing to do. Afterwards, you can just make cash gifts once you've got cash in your hands. But if you've got plans around perhaps making your wealth lasting generations, so perhaps you might have children, grandchildren, and people who are not even born yet, so that perhaps you want to benefit from your hard work that you've done to create this wealth, then the use of a trust could be of benefit to you. A trust also provides control over your wealth as well. So rather than just making a straightforward cash gift, which would enable someone to frankly go out and buy a Ferrari, by having a trust, you can stipulate as and when people receive cash gifts, and frankly, you can also pay invoices on their behalf. So it could, or make contributions towards house purchases, this sort of thing. So you have control over when money goes in. So why we look at this prior to sale is that if you wanted to set up a trust, if you set one up after the sale and you just put cash in, any cash you put in over your available nil rate band, which is normally £325,000, is subject to an immediate 20% inheritance tax charge on the creation of the trust. So if you put in £1 million into the trust, the first 325 would be exempt. The next 675 would be liable to 20% inheritance tax. Whereas if you wanted to put shares into a trust, what you could do is put £1 million worth of shares into trust today, and you wouldn't have the 20% upfront charge on that 675. It would be exempt from inheritance tax. You're saving yourself over 120,000 in inheritance tax to creating that trust. So that's why we look at creating trusts prior to share sales, so that then the trust would receive the proceeds rather than yourself. We're not suggesting you put all of your shares in there, because it's, you wouldn't be allowed to benefit from that trust. You'd also need to, it would only really work as well if your beneficiaries are over 18. Otherwise, you'll be crystallizing a capital gains tax charge on the gift of those shares. If your beneficiaries are over 18, you're allowed to claim what's called holdover relief and not crystallize the gain on the gift itself. You just need that bit of protection, because what if the sale then subsequently falls through? So it doesn't work if the sale is already signed off. The sale does have to have some risk to it. So you'd really want that holdover relief available to you. So the use of a trust can be an interesting tool for inheritance tax planning, for wealth transfer and asset protection. If you're just looking to make straightforward gifts, that's fine. You can do that post-sale. Now, similarly, talking about business property relief for inheritance tax, you normally qualify for that relief once you've owned shares in a trading business for 2 years or more. But the actual test is 2 out of the last 5 years. So if you do sell a company that qualifies for business property relief, you then have a further 3 years to reinvest that money and still qualify immediately for business property relief. So you could go out and look for other investments. If you've got family members who are starting up businesses who might want a little input, or there are certain investments that qualify for this relief. So you could go out and reinvest some of your money into those sorts of investments to maximize the business property relief. You have a 3-year window to do that. Now, we have gone through a few various ways which you can exit, and Philip did touch on this, the ability to perhaps do a family sale, because often we think about in succession planning just simply making straightforward gifts of shares down generations. But some people do take the view, well, I've created all this wealth, I do want something for my retirement to be able to actually take the money and benefit from all this hard work they've put in. So rather than making a straightforward gift to children, it is possible to actually sell them the company. It would work in a very similar way to a management buyout, where effectively you'd set up, the children would set up a new company. You would sell it to that new company. Whatever cash was in your original company at the time can be dividended up to the new entity, tax-free, free of corporation tax. And then that money is used to pay you out for your sale proceeds. And then over time, as the company makes more profits, it can be used to pay you out as a capital gain. And then, as Anand said, that may be structured as sort of deferred proceeds or using some sort of loan notes. So you could do it that way. So it is possible to actually sell companies within families. It doesn't always have to be a gift if there is a desire to sort of at least crystallize part of the value you've created in your lifetime that you need for your retirement. Now, that works where you're looking to step away from the business and you've got someone, a next generation, to give it to. What you can't do, just for as word of warning, is just essentially sell a company to yourself. So you can't set up your own other company and sell it to yourself and try and claim that as a capital gain. HMRC will see that as a disguised dividend because you could have just taken the cash out of your own company. So just a word of warning, there is anti-avoidance rules referred to as the transactions and securities, which stop you selling to yourself. Now, on a family sale situation, we would normally go for a clearance from HMRC to agree that these anti-avoidance rules don't apply. So that's one thing we would need to do before you went for a family sale. Now, rather than just gifting or selling your existing company, another way to get the next generation involved is something called growth shares. So as we sort of alluded to, you have spent a long time building up your business. You may feel, I want to retain the value I've got so far. But if you bring in the next generation, what it's possible to do is set up a new class of share whereby the next generation only benefit from the growth in value from that date. So if you've grown a company to say worth £10 million, you can set in your articles of association that there's a new class of share to be issued that only benefit from any capital event over and above £10 million. And you can then split that growth either between children or include yourself as well if you want to carry on benefiting from the growth in the company. But growth shares is a way to, rather than remove value from the estate, it freezes the value in your estate. So in that example, the value would be frozen at £10 million in your estate if you didn't take some of the growth shares. That would at least enable you to insure against inheritance tax liability and have certainty that the estate would be able to afford the liability if you were to pass away. So there's just some thoughts about inheritance tax. The next one is looking at personal tax considerations and other investment things. So there is some things to think about. So if you had a standalone entity and you undertook what's called a trade and asset sale, so rather than selling the company itself, the company made a sale of the trade, the assets, and essentially client lists, any assets that it may sell, it sold those instead. Then the company would end up with a pot of cash rather than you personally as the shareholders. So how do we get those funds out of that company? Now, companies are obviously always free to pay dividends if they have retained profits, which they are likely to do so following a sale. So you could dividend that out, but you'd be paying income tax on those proceeds. The most likely way to do that is to liquidate the company. So put the company into liquidation. You receive capital distributions during the course of that liquidation. And those capital distributions are liable to capital gains tax rather than income tax. And as long as the distributions are made within 3 years of ceasing to trade, you can still get the business asset disposal relief that Anand described earlier. You are deemed to still be trading for those final 3 years during that liquidation process. So that liquidation process would also apply to something like if you had a company that perhaps didn't have much of a trade if you weren't there. So if you have like a personal service company, something like that, where the trade is heavily reliant on you, and if you retire, you're just going to end up with a company with a pot of cash. An exit strategy there could be a simple liquidation as well. So to get the cash out of that company, cease to trade, essentially retire, and in the course of the liquidation, take distributions, and they'd be treated as a capital gain. Similarly, you'd get the business asset disposal relief if you met the qualifying conditions. Something else that's coming up more and more nowadays is the question about going non-resident. So it is possible to actually leave the country, and because shares are owned by a non-resident are not liable to capital gains tax unless they derive more than 75% of their value from UK real estate, then it is possible to actually leave the country and pay no capital gains tax at all in the UK on a share sale. It obviously depends on the tax position in the country you're going to, but a lot of the people we're talking to at the moment seem to be going to places like Dubai, where there is no capital gains tax on share sales. So It is possible to leave the country, go non-resident, and pay no capital gains tax. That should be caveated to say that there are anti-avoidance rules called the temporary non-residence rules, which means you would have to leave the country for effectively 5 complete tax years. Otherwise, the gain would come back into charge in the year you return to the UK. So it is a bit of a commitment to go non-resident. It's not just for 1 year. You would need to be going for at least 5 complete tax years. So just some final thoughts. As we've mentioned before, we do have a financial services team. Once you've sold your company, you will end up with some cash, and you might need some ideas of what to do with that. So it's thinking about how to reduce your tax exposure. Pension contributions do obviously come with tax relief. That's both income tax, and if you don't have sufficient income tax, you can also reduce your capital gains tax liabilities. And then, as we've mentioned before, about reinvesting into business, property qualifying relief assets, that sort of thing. There are very tax efficient investments that can be made, and our financial services team will be able to talk to you about that in more detail if that's of interest. Okay, and with that, I'll hand back to Philip for a summary.
Thanks, Tim and Anand. So really just to bring together sort of everything we've discussed over the past 30 minutes or so, as a full service firm, we are able to help you as company owners, shareholders, really right from the beginning of a sale process, right through to the end of it. So, we've covered 2 things particularly so far. One is obviously getting the quality of your business right to make it attractive to a potential acquirer. And secondly, there's the whole personal and corporate tax structuring that needs to go round, to minimise tax and maximise value proceeds. So what we recommend as a firm generally is when you are starting to think about an exit 1 to 3 years in the future, we help you really shape your business to get it in the best possible shape and maximise value. And that really involves us coming in, looking at the areas of the business which we feel drive value and which will make you attractive. And we referred to those earlier in the presentation, things like your financial position, your business plan and forecast, your management team, your customer base, just really an outside looking in to make sure all those areas are robust enough. And out of that tends to come a series of recommendations and an action plan and a timetable associated with what we think you need to do in those areas that make you attractive and what the tax structuring part of it needs to look like. So we recommend doing that very early stage. It's a one-off piece of consultancy work, and it really does help, focus you on getting the business on the right path to exit. When the time does come to exit, we are able to help you then through a more structured sales process, which involves us putting together an information pack, agreeing with you parties we think may be interested in acquiring, and taking you through a series of contact offers and negotiations to get the best possible outcome during that sales process with the chosen acquirer for your business. As part of that, we can do the vendor due diligence pack, which is effectively the financial and tax due diligence that a buyer would themselves undertake in a due diligence process. And again, that helps to speed up the exit process. So we're really there from the beginning right through to the end of your thought process and action plan for exit. And as Tim mentioned in his last point, we have a wealth management team that can actually help you with the investment and management of those proceeds once the sale completes. So that's really just about it, I think, from us. Hopefully we left you with some very clear messages about the importance and benefits of exit planning. It really does come also back to where we started with, the sale of your business involves many aspects, many stakeholders, and it needs to be tied in with your personal wealth objectives and your personal objectives of you as well, what you want to do as you retire from the business. So we're here to help, and many thanks for your attention today.